Welcome to the Independence by Design podcast, where we discuss what it means to be a business owner and ways to get unstuck from the day-to-day so we can design a business that gives us a life of independence. There's this gaping hole for investment banking firms in the lower market for the $5 to $50 million company range where they're actually doing a controlled auction where you're actually selling a company with the investment banking process and not just slapping a logo on a website as a business broker often does. And so I've got John Bartlett on the show. He is a longtime listener and has become a friend over this last couple of years. And he started Brentwood Capital after multiple of his own growth and exits. One of his companies he took from 10 million to over 100 million bucks, had all of the challenges of growth and scaling a company, has been through multiple exits his own, and his company does dozens of deals every year. And he walks us through all of the lessons that he's learned over the decades and the ownership mindset, all the challenges that we see in the lower middle market, why this big gaping hole of the lower market of the, call it $5 to $10 million to $50 million value range. Why is there an issue there? What are the things that these owners and we can do to actually grow value? And then he talks about he breaks down a very detailed explanation of what the process is of selling a company. If what you have decided is the right approach is to sell to a third party, not an internal transfer, not an ESOP, but if a third party sale is the right approach, he's got a list of 3,000 buyers. He has a machine that he has built to the point where I trust him, where I've referred him a handful of clients. And I was so impressed on one of the calls. I was like, you know what? Let's get you on a call and I get you on the podcast and let's have you walk through your mindset, your history, and your approach to selling a company. So that's what you're in store for today. I hope you enjoy it. Here's John Bartlett with Brentwood Capital.
The longer that I've been doing this, the thing that I've realized is it to me the real significance is how many people can I come in contact with and how many people can I positively help them navigate through this journey of their life. And I mean, we have so many leads that are coming in the pipeline. I mean, dude, literally we have 600 owners a month that are raising their hands and saying they want to have a conversation about the business. And then we'll talk to 75 to 100 a month, and we'll do valuations on 20 a month, and we'll bring maybe 2 deals a month to market. So when you hear those numbers, the vast majority of the conversations we're having, we're not bringing those deals to market, and they're not coming to market because either the owner's really not ready to sell the business, or the value of the business is really not where he needs or she needs for it to be, or wants it to be, or there are other characteristics that are in the business that prevent the business from coming to market right now. And so, it's not just about helping.
Where does your desire for impact come from now? Like, in your stage, Jen, you and I have talked, like you want, because you've made financial freedom. It's like, why are you doing this? You and I talked when we first met, like you've been listening to the podcast for a long time, it sounds like, and you're like, I just want to have fun. And you said
I have been listening to your podcast for 5 to 6 years now.
That's so cool.
Literally. Yeah.
And you're still here.
I'm still here. We're still talking.
And you said retirement meant nothing to you at that point because you're having fun.
I laughingly say that I'm not fully evolved as a human because I don't have enough outside interest, and I'm needed. I needed this to give me purpose. I mean, I've got 5 kids and starting to have some grandkids, and I've got that, but I don't play. I mean, I play golf, but so.
Well, you and I talked, like sports and all this other stuff. We were talking about who we follow and what's interesting to us.
Yeah.
And
Do
you feel like a lot of the owners that you meet are similar? Because like you and I have talked about Bo Burlingham and this identity, and you run a process with like the sheer volume of people. Like, what is your definition of like the second or third act of like how you view it? What does equal happiness to you at this point?
Well, for me, it's making a difference in people's lives, and you can call it sort of a spiritual contribution that I'm making, but it's, you know, there are just so many people out there, good people that have built good, successful businesses, and they're trying to figure out what to do next, and they don't know where to turn. And they're looking, if they're ready to sell the business, they're looking for someone that they can trust that can help them figure out how to get a transaction done. And you know, everybody is motivated a little bit differently in terms of how they want that transaction to look like and what's important to them. It's, you know, is it just the price? Is it just the deal structure under the price? How concerned are they about who buys the business? How concerned are they about what they're going to do with the business? How concerned are they about the legacy that they've built? How concerned are they about how the buyer's going to take care of their employees, take care of their customers? And so, you know, when we begin this conversation, because so many of these sellers have never been through this before, they've never thought that stuff through. And you know, they come to us, you know, you get owners in their 60s or 70s that are just burned out and they're tired and the kids don't want to take over the business and they need to sell the business because, you know, 80% of their net worth is equity that they have in the business. And so they need to sell the business to free up the capital, reinvest the capital to give them the income so that they can retire, and they got to free up their time. And so they're they're at one stage, okay? And then you've got sellers in their 50s, let's call it. And, you know, they've still got some gas in the tank. You know, they've got, you know, 2 to 5 years, call it. But they're wanting to pull some cash out of the business, de-risk their balance sheet, put some cash in the bank, give them a little bit of breathing space, stay involved in the business, continue to run the business, have some additional capital and some additional structure to support them, allow them to become part of something larger. And, you know, everyone wants to throw the concept of rollover equity and second bite of the apple. And, you know, all those are good sound bites and they're real, but where the rubber hits the road is, you know, you get these guys in their 50s that are not, they haven't figured out what they're going to do as the next chapter. And so they're not there yet, but they're wanting to begin to put a plan in place to give themselves time to figure that out and to know that they have an offer out. Okay. So
What if
that's
they
sort of,
find out that they're, what did you say, an unfunctioning human being like you?
yeah, that's me. That's me. That's me.
I think there's probably a significant percentage of those people like us, though.
Yeah, yeah. And then there's the third group. And the third group are, you know, owners in their 30s or 40s. You know, they started the business and they've scaled the business as far as they feel like they can scale it on their own. And they know they need help taking the business to the next level. They need help in their systems. They need help in their processes. They need help understanding the financials the right way. They need help in building the leadership team out. They need help in getting the KPIs and the metrics. And so they're self-aware enough to realize that on their own they were able to take the business to a certain level, and in order to take it to the next level they need someone to help them do that. And so they're they're looking for an investor, a partner, a mentor. Maybe it's a private equity firm, maybe it's a strategic, maybe it's some sort of partner that can help them scale the business further. And so that's sort of the third category, is they're they're not really thinking about the end game because they're not there yet in their life, but they're realizing they need help to be able to scale the business beyond where they're able to take it on their own. And so all these conversations that we have, quite frankly, everyone sort of fits into one of those three categories. They're in their 30s and 40s and they're here, or they're in their 50s to early 60s and they're here, or they're in their 60s, early 70s and they're here. And what their objective is a little bit different, because where they are in life is a little bit different. And I tell guys and gals all the time. I say, listen, life is like a jigsaw puzzle, and you've got a bunch of pieces on the table that are moving around all the time. You've got the financial side of your life that's all about numbers. It's, how much money do I have in the bank, and what's the income off of that, and if I sold my business today, after I'd pay taxes, after I'd pay fees, what would that give me? And how does that fit into my overall investment strategy? And do I have enough passive investment income to cover my burn? And so you've got all the financial side of life, which is all about numbers. And then you've got the life side of life, which has nothing to do with numbers. It's, do I still enjoy what I do? Do I still have gas in the tank? Do I look forward to coming to work every day? Um, am I burned out? Am I stressed out? Is my work-life balance all out of whack? Is my marriage suffering? Am I being a jerk as a parent? Are there other interests that I have in life? And so all of these life side of the things have nothing to do with numbers at all. It's totally separate. And so, look, I mean, I say this all the time. I'm not a marital counselor, and I'm not a therapist, and I'm not a life coach. I can't help you figure all that stuff out. You got to go figure all that stuff out on your own. I'm not a wealth advisor. I'm not a financial planner. I can't figure all that stuff out. I mean, I can tell you what your business is worth. I can tell you what your business could be worth. If you're ready to pull the trigger and you want to get a deal done, we can have that conversation. If you want to figure out how to help you scale the business further and have the conversation down the road, we can have that conversation. And so I say I'm a little bit like Liam Neeson in the movie Taken. I've got a very specific skill set, and I can do this thing right here. I can't do all that other stuff. I
that's
can't do all that other
that's
stuff.
fantastic. And what I have enjoyed about our conversations this last year, getting to know you, is you and I had lots of conversations of all of the different pieces of the jigsaw puzzle that we all these, because you have your own ownership journey and I'd love you to kind of just touch on a little bit, because this doesn't come from John's been an investment banker for his whole life, right? And so I want you to give some context on that. But before, it's like all these jigsaw puzzles, John, you and I think we share this passion of, there's a lot of propaganda, misaligned incentives that make everything that you just said even more difficult. And so when I got to know you, it was like, it's just so nice, because like how you framed all that up, it's like I think you and I are both almost trained to, we have to give all the context so that way we say, we do this. And so, where did your passion from all of the complexities of what you just said and all the different providers and the different things that happen, like, why is this the passion that you've landed on, even though you don't need to be doing this, and that this becomes your way of impact? What's your personal passion behind this topic?
Well, this has all been part of the journey that I've been on. I'm 68, so I mean, I've been doing this for 40 years, and so my story. I was a serial entrepreneur. I've bought, run, and sold a handful of businesses, and I went to college. I was a history major at Vanderbilt, and so
I don't know if I knew that.
no,
That's
no. I,
awesome.
I mean, I mean, I you know I mean, balance sheets and financial statements and all that stuff. I didn't know any of that stuff. And so I got into finance out of school, and I sort of learned it working for a bank. I ended up buying a business in my early 30s, moved to New York, and
What kind of business was it?
it was in the financial services business. It did regulatory support for publicly traded companies and mutual funds that had a lot to do with the SEC filing requirements that they had, and so it was very niche focused.
For professional services business
Yeah,
model,
yeah,
essentially.
yeah, yeah, yeah. Now, I mean, one of the businesses that I bought, when I bought it, we were doing around 10 million and had about 25 employees. And then over a 7, 8 year period, we grew it from 10 million to 100 million and from 15 to 20 employees to 300 employees. Now it was through the growth of that business that I learned so much about running a business. And, one of the things that I learned is, businesses go through phases based upon the size of the business, based upon the number of employees, based upon what the complexity of the business is, based upon what the leadership team looks like, based upon what the owner's role and responsibility is. And if you go to my website now, you'll see this condensed in this concept that I've come up with that I call the 7 levels of growth. And I talk about businesses falling into 7 different categories based upon the size of the business. You've got a business that's doing 500,000 of less and it's going to look and feel a certain way. You've got a business that's doing 1 million and it's going to look and feel a certain way. You've got a business doing 2.5 million, a business doing 7.5 million, a business doing 15 million, a business doing 50 million, a business doing more than 50 million. And so those 7 levels of growth and how the owner needs to think about the business, that whole concept came from the experience that I had growing that business from 10 million to 100 million and not understanding until I went through it. You go from 20 employees to 50 employees to 100 employees to 200 employees to three, and the business and the complexity of the business changes. And no, it's not. It's not. And what your management team looks like, what your leadership team looks like, what your KPIs are, what your role as the founder owner, how it continues to evolve as the complexity of the business changes. And so much of what I learned about what I practice today, I learned through that experience, through growing the business at that very rapid pace, selling the business, and then buying and selling another 3 or 4 businesses, applying similar processes and logic to that. Now, I tried to retire. I wasn't good at it. I wanted to go find something to do. And when I looked around and said, okay, what is it that I can do where I feel like I can add value to the world and I feel like it would be something that I would enjoy doing, I decided that being a baby boomer, working with baby boomers that were wanting to sell their businesses would be something that I would enjoy doing. And so that's how I came to start Brentwood. And I started Brentwood 6 or 7 years ago. And then when Brentwood got up and going, and I began to have all these conversations with all these business owners, what I didn't realize at the time when I started it was how many of these owners, um, the value that they need to sell the business for and what the value of the business is, there's a gap there, and how much of a need there was to help these owners figure out how to close that value gap that would allow them to have this a successful exit. And so it was through all these conversations that I realized, well, I think there's a and you've come to the same conclusion there. Business owners need help figuring this stuff out, and so that's where the whole consulting part of our business that complements the M&A side of our business sort of came together. And so I mean, I got to tell you, dude, I don't have to set the alarm in the morning because at 5:30, and I feel really, I'm going to use the word blessed, and it sounds like a hokey word, but I feel very fortunate that at this stage of my life, I found something that I enjoy doing as much as of this that I do, that I feel like I can help impact people. And dude, I just can't wait to get out of bed every morning.
I love it, John. And, you know, do you think that it's possible for owners to get the experience that you're having while they own the company?
Absolutely. Absolutely.
What do you think you could have done differently, or what do you think are parts of the ingredients to do that?
Um, I think you've got to get your ego out of the way. You've got to um, you've got to be able to put processes in place. You've got to be able to hire the right people. You've got to be able to put the right reporting structure in place. You've got to be sure that um, the culture in the businesses is right. Look. I'm a huge fan of Warren Buffett. Okay, and I mean, freaking Buffett just retired. He was 92 years old.
Yeah, Charlie
And,
Munger did you and I talked when we first
and
met. Charlie
Charlie
Munger did
Munger lived to
a
be
board
what,
meeting
98?
6 months before he died, right?
Yeah. And so don't tell me that it can't be done. Don't tell me that it can't be done.
Because
I
that you got 30 years, man,
I
on
know I
that
got a
clock.
long runway left. I went to a conference this past September. Have you ever read any of Jack Stack stuff, The Great Game of
He's been on
Business?
the podcast a couple times.
Oh, Jackass.
Yeah,
Oh,
yeah,
I
yeah.
didn't realize. So
He was like out like episode like 100 and something like that. So it's
how old is Jack now? I mean, Jack's got to be in his 80s.
he's like 82, I think.
82. I went to the Great Game of Business conference that they had in Dallas, in Arlington, past September, and Jack was there. And you know what? I mean, 82 years old, Jack's still together, man. And so my point is absolutely it can be done. Absolutely it can be done.
So I want to pull this thread for two reasons. Because you've been listening and you've been hearing me think through and organize my thoughts and ideas over the last 5 years. But also, I think we can tie this ownership versus operator idea together for people. Because what I want to frame up also is I I think that you have solved a very specific problem in the marketplace. I think you have Liam Neeson. I'm going to call you Liam from now on for the rest of the episode. Is your ability to help these people that are in the lower middle market where it's all this broker BS, where you are doing investment banking style approach to some mutual clients that you and I have been working with, where I literally said, okay, I want us to like recreate that whole conversation because I watched how helpful you were to her, walking her through all of the implications of the process of selling the business, the implications and the milestones. And John, I think the context, what I'm excited about with, I'll see if I can get to the answer or the question here is like, when I got on that call with you two, there was total clarity of why selling to a third party was the route. So I think I did my job of like, okay, what are all the goals? What's the difference between operator and owner? What are all the possibilities? Because the question I just asked you, could you do this while you own the company? It's like that question should be answered within the context of what are the goals. but it's like layering this idea of there's a job and then there's an asset. Cause I think Charlie Munger and Warren Buffett and you or I, like, we can do this forever because we're not sucked in the middle of the vortex of all the bullshit in the company. And I personally want people to be able to see that possibility before they raise their hand and say, okay, I see that possibility, but I still would like John to sell my company. And then you did a great job saying, here's exactly all the implications. So kind of two parts to this, as I'll wrap or summarize it, is kind of the owner operator thought process and how someone could design a business and keep the business without being destroyed personally. And then we can go on to like kind of the train of like, if you decided to sell, here's like the process that it would have to go through and the things to think about. But first, like, what do you think about that owner operator bifurcation that I've made over the last couple of years?
See, I think what people are, and you and I have had this conversation. See, I think what people are really what owners, if if you take the age component out of the equation for a moment, what everyone really is trying to accomplish is they want work-life balance. That's really what they want. They want to be able to they want to be able to prioritize their life on their terms and not feel like they're beholden to something where they feel like they have no control of their life. And I think where a lot of business owners get stuck is the business consumes them, and they get to the point where they're working 60, 70 hours a week and everything flows through them, and they can't they they feel like they've lost control of everything. Their finances might be a mess because the business finances might be a mess. They're not running the business properly, and so their employees, there might be dysfunction or tension there. Their home life is a bit of a wreck because they're not able to spend time, and so
Like this spiral down.
yeah,
Like
yeah, yeah, yeah. And no, and I have so many of these conversations every day where I can just hear it in people's voices.
mm-hmm,
And so they can't figure out how to get out of that death spiral.
mm-hmm, mm-hmm.
And so the only thing they can figure out to do is just screw it, let me sell the damn thing and start over. You
You
know,
literally did, you literally just summed up my dad's strategy in
yeah,
2014 when we sold the
yeah,
business.
yeah. It's like punt, and what they don't understand, and maybe they're too far deep into the abyss to ever properly see this, is they don't understand and appreciate the power of the economic engine that they're sitting on. The power of the economic engine that they're sitting on. If they can if they can get the right leadership team in place, if they can get the right reporting structure in place, if they can get the business at the right profit levels, if they can get the cash flow and the profitability of the business right, if they can get all that right, and instead of them working 70 hours a week, getting crushed, making no money, where they could be working 10 to 20 hours a week in the business and have the right work life balance and get a fair salary compensation out of the business and get tremendous distributions that are coming out from the profits of the business. If they were able to structure that properly, where it's 10 to 20 hours a week, you're drawing a salary of whatever, 2 to 300, whatever, you're getting distributions of 500, 750, a million, whatever.
Mm-hmm.
You're freaking working 10 to 20 hours a week, making seven figures.
Next thing you know, you're Jack Stack and having fun until you're.
Yes. Yeah, 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 yeah. People don't realize that life is possible.
This is why you and I need to do more work
I
together
know.
because So what, John, like what you just said, like as you have told me and after our conversations, 'cause I get so passionate about the weeds, but I also I'm trying my best always to go from the zoom out, zoom out, and have that through line. But I think what you just said could not have summarized my belief and my mission either any better. And when I think about the implications of why that is and what I have learned over the last 8 years is the inability for most people to see their cash flow into the future becomes the Achilles heel. So like there's been this un or unnecessary or there's been an overweight of my dialogue for years on the financials only because I want to be more in the other visionary, the life stuff. But it's like, well, how many EOS integrators or asset managers are going, just insert the ridiculous Dr. Phil advice after 7 minutes. And it's like, well, I want to know, or like, let's take one of, like, I have a client, John, they weren't even pulling a salary 18 months ago. It's about a $40 million business. It had a big, very lumpy cash flow, like 30-year-old business. Like this is a good business, right? It just happened to be very challenging for that year. No salary, no distributions, bank covenants. I mean, all the bullshit of all the stuff that we know. Fast forward to today, has a CEO taking 30 grand a month in ownership distributions after taxes, after debt, after working capital, after everything. Has complete visibility for 5 years how they can continue to make essentially 300 to 500 grand in distributions without a job. The CEO is running the company, all of the metrics tie together, and they're going, like they literally got on the call and like, I'm on these calls because I don't know what else I'm supposed to do at the business.
Yeah.
And I just
Yeah.
had, so it's
And
interesting because like that, it's that cash flow, like every single decision. It's like, well, when's the through line? And they can't see it. So then it becomes hope because they're just looking at an income statement. And I don't know what your thoughts are on this, but that's just kind of, it's like the Achilles heel. So there's a lot of conversations around it, but it's not all about that. It's like once you have it in place, then you can forget about it because you can do other stuff.
yeah, and I don't mean to crap on the business consultants out there.
Oh, come on. It's okay.
There are a lot of good ones. There are a lot of good ones. The problem that I have with them is, and I'll talk to tons and tons of these guys, EOS guys and Vistage guys and scaling up guys and Pinnacle guys and all these coaching consulting groups
Exit planners, wealth managers, bankers. I mean, like it's just, but it's every advisor and consultant, right?
100%, 100%. So my thing is if you're, you could talk about all of the friggin' operating systems that are out there, and if your operating system is not being grounded in the financial performance of the business and all of the strategy that you're putting in place, if that's not being additionally grounded in, are you building shareholder value? Are you building enterprise value? If you're not tying all three of those legs of the stool together, then
Realistically,
not
not from
having a
like
complete conversation.
and like 100%. And like, yeah, as you and I both know too. And it's not just from like some random consultant's Venn diagram or pyramid. It's like actual financials. And like
Actual
John's going to sell
financial.
the company and someone will write a check for $20 million because the discounted cash flow. Well, sure. Like, and
$100.
it's like, John, it's like you've heard me on the podcast talk 1,000 times. So like, it's the healthcare system. It's
Yeah.
like, no one's like, hey, John,
It
you
is. It
healthy?
is. It is. Yeah.
And it's wild, like and all of the ownership then goes on to the person to be the advocate for themselves. And you and I think, hear it in everybody's voice. They're exhausted with this
yeah.
shit.
Yeah. Yeah. No. And I've heard you talk about you're comparing it to the healthcare system, and I think you're absolutely right. I'm not saying it's intentionally being managed this
Right.
way,
Right.
but I just feel I feel like people are not having real conversations. You've got to you've got to you've got to look at the financials, you got to look at the P&L, you got to look at the cash flow statement, you got to look at the balance sheet, you got to be sure that you're running a financially healthy business. You got to look at your strategy, you got to look at your leadership team, you got to look at your 90-day rocks. You've got to be sure that you're working on the right stuff. Everything needs to be grounded in what's the objective that the owners, the shareholders want to have with the business, short term, medium term, long term, and everything you're doing from a financial standpoint and from a strategic standpoint needs to be grounded in terms of what your long term objectives with the business are.
Because then we can have that complete conversation, which I
100%. 100%.
yeah, then it's like, and like it's this is why I got along with you so well when we first met, because it's like I have felt like a part of me has just been insane for
No,
years. And like, and I have like, and if you've been listening to me long enough, you know that I've struggled with like being cynical to being like crabby about it to being like laughing
yeah.
about it. And it's like these different probably stages of grief going
Well,
because I
look,
just want to have meaningful conversations that are
yeah.
complete with people.
And look, part of what we try to do is okay, let's determine what the value of the business today is, and let's agree with the methodology that we're using to determine the value of the business. Okay. And so okay,
Do
you know,
you
your
do you want to
business
roll
is
this? Do you want? Sorry to interrupt, but do you want to like take this into your process of like, okay, like how you go through, or do you want to? I
no,
mean, do you,
and it's like, you know, the very first conversations that we have with people, you know, I will listen to them. They'll explain the business, they'll explain their model, they'll explain the management team, and then I'll say, what are you wanting to do with the business, short, medium, and long term? And then, you know, some of them will be able to articulate that, others will not, because they it's almost like they're afraid to throw something out there because they don't even know what's possible. And so I'll say, okay, cool. Let's do evaluation as to what the business is worth today. And let's put some projections together with some reasonable assumptions as to what the business could be worth 2 years from now, 5 years from now, 7 years from now, 10 years from now, whatever. And then I think when we sit down and look at the value of the business today and how we arrived at that value and look at the projections and assumptions that we've made from a growth standpoint, from a margin improvement standpoint, from an EBITDA standpoint, from a multiple expansion standpoint, when you look at those assumptions, you'll see what the potential value of the business could be at some point down the road. Okay. And they'll say fine. And so, you know, we'll get an NDA in place and we'll get the financials and we'll do the valuation and da 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 da. And then I'll come back and say, look, the value of your business today is X. And this is how we arrived at X. You know, this is what the adjusted EBITDA is, this is what the multiple range is, this is what the value is. Now, if if the business grows at this rate and if your margins improve and if your adjusted EBITDA goes up and we do all of these other things that's going to expand what the multiple is, this is what the business could be worth in 5 years, 7 years, 10 years, whatever. And so all of a sudden they're like, wait a minute, you're telling me the business is worth 5 million today, and you're telling me if I do these things that the business could be worth 15 million in 5 years. I said, yeah, that's what I'm telling you. And they see how that's accomplished from a financial standpoint. You know, we're going to grow the top line at 20%. We're going to get the margin improvement here. We're going to work internally on the infrastructure of the business. We're going to get the multiple up. All of a sudden, they see what the value of it could be, and then you can start having the conversation of, do you do you want to build the business to that value over this period of time, and do you want to sell it, or do you want to build your management team up and then you pull back from the business and you can see how the profitability and how the distributions of the business could be at a much higher level 2 or 3 years. All of a sudden it makes sense to them and they see it. And now
And
and now
you know why I think it's answering the question, John, is without that point B that's grounded in reality, the person, because I'm seeing the same reactions, is they can look at that and go, is that worth it to me? And we can't answer that question without that framework to say, okay, John, well, you just told me, I'll give you two examples of two opposite reactions to that I think are both okay. One of my clients, they said, oh my God, that's all. Now I've got the path forward and I can go from that to that. And that's economic wealth. And now I have meaning to all of the hard work every day instead of just hoping. So someone gets gravitated to sign me up. The other person, I had two clients actually, as we walked through that, they went, no effing way do I want to go through that misery over 5 years? Because it's going to take from 25 employees to 50 employees and all the headaches. And instead, if I just save 400 grand a year in my assets and then not overwork myself, I still get to the same net worth in 5 years. And neither are wrong, right?
No, and I couldn't agree more. And we're not here to be judgmental, and we're not here to force our value system on them. We're here to help them see what alternative paths are, to be sure that they feel like they're headed down the right path and they've got a plan to get there.
It's visible, right? Because and that's where I think it's so synonymous to the health space, because
100%.
you go, okay, like you come to me and you're like, let's say you're 400 pounds. You say you want to run an Ironman tomorrow. I'm going to go like, hey, we got some serious conversations that we're going to have. But we're just trying to map expectations, reality, say like, what level of effort do you want to put into your goals? We can change the goal. We can change the timeline. We can change the effort. But like, we're like, it's seeing clearly for the first time, what is it going to take to get the outcome that's meaningful? And that's where I think you and I have synced up on. All of the other consultants and advisors are not grounding this conversation in cash flow and valuation, which means it's all just
correct. Yeah.
Based on what?
Yeah. I couldn't agree with you more, Ryan. I couldn't agree more. Yeah.
So my audience, as you've probably gathered, have heard a lot about the ownership operating system, the cash flow, like thinking about the numbers and all that stuff. Like if we said for a moment, hey, someone went through their goal setting and all that stuff and says, you know what, I actually want to sell my company through third party. I don't want to do an ESOP. I don't want to do an internal transfer. I don't want to sit in the boardroom for the next 5 years. But John, sign me up for a sale in 12 to 18 months. I want to, in the next half hour, 40 minutes, to unpack for the listeners their ability to map what the level of effort is. So if we kind of use that, is it worth it or not? Because it's not just hey, John, you said it's worth 15 million. That's not enterprise. That's not how much goes into your pocketbook. You have the role. You have all of these decision trees. Like when you and I were on that call with my client, you did such a good job where like at the end of the call, I think she was able to go, I can see what the next 18 months would look like. I can see how much money would go into my bank account. I can see what level of effort's going to have to be applied. And you just did such a good job from that first moment all the way to even like the last 18 months of the earn out or
yeah.
Comes in.
So let's.
Is that helpful?
Yeah.
Frame?
Yeah, totally. Let's first talk about valuation, and then let's talk about deal structure, and then let's talk about timeline.
I love it so much.
And let's sort of put everything together here. So first, valuation.
Sorry to interrupt. Before you do that, maybe framing up the size client, why there's a gaping hole in your marketplace that you and I are also working on. So before you kind of go into that whole series of, because I think it's like, who is this appropriate for and the size, and why is it a unique thing of what you're doing?
Yeah. So the market that we really focus on is companies that have enterprise value roughly between 5 and 50 million. Now, does that mean that we can sell companies below 5 million? In some instances, yes. That means we can sell companies greater than 50 million. In some instances, yes. But to when I started this business, that was the market that the size of the market in terms of enterprise value of the business that I really wanted to focus on because I felt like it was undercovered and underserved. You go below 5 million, a lot of business brokers are sort of in that space, and that's where they are. You get above 50 million, investment banks begin to crawl into that space. Some of the larger New York and Chicago banks are sort of there, but there was this sort of
Hmm.
underbelly, if you would, where I felt like the businesses had some significance and they had some complexity, but they were above where brokers could handle and
Hmm.
below where a
It's
lot
really
of
the backbone of America, actually, is what I see.
I mean, to me, that's America. To me, that's
Yep.
America. Anyway, so that's the market that we focus on. Um, now, um, from a valuation standpoint, and I know that there are a lot of different ways that valuations can be done, but to boil it down in its most simplistic fashion, it comes down to two numbers. It's what is the adjusted EBITDA cash flow of the business that a buyer could realize if they own the business, and what multiple of that cash flow are they willing to pay? It comes down to those two numbers. Buyers are buying businesses' ability to produce free cash flow profits. And I don't care if you're talking about Amazon or Google or
That's how the
Facebook.
world works.
Yeah, and PE multiples and multiples of privately held businesses, they're measuring the same thing. It's buyers or investors are buying the business's ability to produce cash flow, and they manage their risk of that cash flow changing by the multiple that they're willing to pay. Smaller businesses with more risky cash flow, they're going to pay a lower multiple for those businesses. Larger businesses with more consistent, predictable cash flow, they're going to pay a higher multiple for those businesses. And so it comes down to two numbers. What's the adjusted cash flow, um, profit EBITDA of the business, and what multiple is a buyer willing to pay? Now, I mean, you go to conferences and you go to the country club, and everybody will say, I sold my business for 8 times, or I sold my business for 10 times, or Fred sold his business for 14 times. Everybody loves to talk about the multiple. And the multiple matters a lot. It matters a lot. What what no one wants to talk about is what was the deal structure under that headline number that a buyer was willing to pay for the business. And when you first throw this out, people say, "What the hell are you talking about?" And I mean, if someone's going to pay 10 million for the business or 20 million for the business, I mean, whatever the number is, that doesn't mean they're going to pay 10 million of cash. I mean, they might, but there might be some structure.
I'm going to give you 10 million for your business, John, and it's going to be 100-year note at 1%.
Yeah. I mean, there's a chance there's going to be some structure in that sell price. And when I say structure, what I mean is how much of the 10 million is cash? How much of it is a note that the seller might take back? How much of it might be in the form of an earnout, meaning if the business performs at these certain levels over this period of time, we'll pay you additional cash bonuses. How much of it might be in the form of rollover equity, which means if you're selling the business for 10 million, you might only be selling 80% of the business, and you might continue to own 20% of the business, and that 20% might go into a larger holding company, and that larger holding company might sell in 3, 5, 7 years. And so you're hoping that the 20% that you left in the business when that holding company goes to sell the second time, that 2 million ends up being 6 million or 8
Hmm.
million or 10 million or a much bigger number. And so one of the things that every seller needs to think through when they're thinking about going to market is it's not just what is a buyer willing to pay for the business, but what is the underlying structure of that acquisition going to look like, and what am I willing to live with and what am I not willing to live with.
Hmm.
And
Hmm.
so taking the time to understand the structure, it matters a
It's
lot.
paramount. It's like,
Yeah, yeah.
yeah.
Because you as a seller have to be clear. And if you're dealing with a banker, or you're dealing with an M&A group, or you're dealing with a broker, or you're even selling the business on your own, you've got to be clear in your mind when you go to market what you're willing to accept in terms of sale price and in terms of structure, and what you're not willing to accept.
Mhm. And I want to layer on too, then also how that impacts what you're willing to do and not do as a operator inside of that structure, right? Because like if they're trying to get out of their job, but all of that is hinging on them still working. And so, one thing because it is and then net proceeds.
Yeah, I'm going to get to that next. I'm going to
Okay,
get to that next.
when do you just to spot check you for a second of you did a great job of talking about adjustments in normalized EBITDA. Do you want to like talk about that now, or
Yeah,
do you have a drink?
no. And so, yeah, and so, um, I tell people all the time, the value of the business comes down to two numbers. It's the adjusted EBITDA number, and it's the multiple that the business is going to trade for. And so we get back to what's the adjusted EBITDA number. And so, everyone says, "Oh, I'll send you my tax return." And I said, "Okay, you can send me your tax return, but is
Is
we
that
all do the
serious?
same."
Do you hear it that much too?
Oh, yeah, yeah. And I'll say, okay, send me the tax return because that's a good starting place. But we all do the same thing. We hate to pay taxes, and we want the business to pay for as much as we can. And so the tax return's not showing it's not showing the real story. And they'll say, "Oh, I guess you're right."
Nor
Well,
is yeah.
okay. So I will send you my QuickBooks files. Okay, and I'll say that's great. Send them to me. And so they'll send me the files. They'll download into Excel spreadsheet. They'll give me access to QuickBooks, and we'll download everything. And we've got revenue. We've got all the chart of accounts. We've got cost of goods. We've got gross margin. We've got OpEx. We got SG&A, and then we've got operating income. And so I'll start looking at that operating income, and I'll say, are there any personal expenses in here?
No.
Absolutely. Are there any non-reoccurring charges in here? Absolutely. Um, do you have family members? Are there other are you overpaying people? Are you underpaying people? Absolutely. And so what we have to do is we've got to get that operating income number that comes out of QuickBooks, and we've got to make add backs and adjustments as to the way a seller's going to run the business, um, pulling out all the non-reoccurring and non-critical expenses and one-time charges to show the seller what the true adjusted EBITDA cash flow is. And so you've got to make all those adjustments because you want to get that number up as high as you can. And
Realistically, right? That's what you did.
realistically, yeah, I mean, you can't lie and you can't cheat, and it's going to have to go through a quality of earnings. So we got to be able to verify everything. So, you can't bullshit stuff, but we want to try to show, in Ryan, this happens all the time. I get the tax return and it shows that the business is making $200,000. I get the QuickBooks files and the net income in the QuickBooks files is maybe $700,000. We start doing all these add backs and adjustments, and we find out that the real adjusted cash flow of the business with all these add backs and adjustments might be $1 million. Now, remember, the tax return showed 100,000. The QuickBooks files showed 600,000 or 700,000. The real number's 1 million. We got to get to that. We got to get to that $1 million number because that's the starting place that the multiple is going to be based off of. That's going to determine what the value of the business is. So all those add backs and adjustments help us determine what the real number is, and when we multiply that against what the reasonable multiple range is, that gives us the value of the business. Now, let me talk about multiple range for a moment, because multiples are not static. Multiples, they remember what a multiple is. A multiple is the number of future cash flow years that a buyer is willing to pay for a business. And so a high risk business that they're willing to pay a multiple of 3 times means they're taking that cash flow number of $1 million, let's say, and they only have confidence that that cash flow number is going to stay at that level for a 3-year period. And so they're willing to pay you a multiple of 3 times. If it's a more stable business with more consistent cash flow, that they're willing to pay you a multiple of 5 to 6 times, let's say, what they're saying is the risk of that cash flow is much, much less. I'm willing to forward pay 6 times cash flow for that business. And so in order to get the multiple up, we've got to do everything we can to internally de-risk the business from a
Improve that
buyer's
story.
perspective, so that they're willing to pay a higher multiple for it. We've got to change what the revenue mix is. We've got to change what the client concentration is. We've got to change what the leadership team is. We've got to change. We got to get out of project-based work over to reoccurring or recurring-based work. We've got to reduce what the owner dependency is. All of these internal strategic things that we're doing in the business while the EBITDA is growing because we're growing the business, we are de-risking the business. And as a result of that, the multiple is going up also. And so you've got 2 things working here. You got a higher cash flow number and you've got a higher multiple. And when you multiply those together, you get a compounding effect in terms of the impact that has on the value.
And John, with one of the case studies that I've been working on building out for my Owners Academy, going from 1.5 million in normalized EBITDA to 3 million over the course of 5 years, and going from a 4.5 multiple to a 6.7 ends up being a 25 or 29% CAGR because
100%.
you're getting both that growth, and it literally is, it goes from a $5.5 million company to $21 million in 5 years. I mean, it's just, and it ends up being only like 14% normalized EBITDA growth or something like that.
Yeah.
So it's just, I think everything that you had talked about, and we both said about the consultants and the projects and the advisors should be through this lens.
I agree completely. Let me tell you the other thing that happens too is as the business gets larger, the buyer pool changes.
And deal structure as well.
Yeah, and the deal structure changes. And so, there is so much institutional capital out there chasing deals. And you know, we can hate on private equity all we want to because of what they do, what some private equity firms do with businesses and how they destroy the value and the culture of the business because private equity firms are so financially driven in terms of the way that they look at these businesses. Not all institutional capital is the same, I'm not saying that I'm not saying private equity firms are
Let-
good or
Let's let- let's do this for both your and I's sake because you're doing a very good job at I think dancing around. Like here's how I would word it, John. Is there's the whole like stock tip. Like the moment you hear your grandma or your Uber driver talking about it, you know that their returns are gone. And private equity and venture capital and all of these have very specific reasons to exist. But when you have your grandma and the Uber driver talking about private equity, it's gotten too big as a percentage of the whole. So that then brings in the bad actors that crowd everything else out. So I think I'm just saying this on behalf of both you and I. Like, I know really good private equity firms, you do too. And if they're smart people with good intentions and they're deploying capital the right way, there's just a shitload of bad
100%.
actors
Yeah,
because of the
yeah.
cheap debt for the last
Yeah, and
5 plus years.
look, we've got I've got close to 3,000 buyers in our buyer network that we've had conversations with, and it's private equity firms, it's independent sponsors, it's family offices, it's strategic buyers. I've got search funders, and so I mean it's a hodgepodge of everything out there. And when I think about all these conversations that I've had, there's some really good people that I've talked to and some really awful people that I've talked to as well. It's like
Yes.
anything in life. So the way we run a process, and I can't speak to anybody else, but when we agree to take a deal on, it takes us about 30 days to get the marketing material put together that we're going to market the business with. And it sort of falls into two components. There's a one-page summary that's called a teaser, and then there's a 20 to 25 page, much more detailed presentation that's called a SIM, a confidential information memorandum. And so it takes us about 30 days to get both of those documents prepared. The teaser does not have the name of the business. It goes out to a much wider group. That detailed 25-page report has a lot of information, a lot of very specific information about the business. It has the name of the business. And so no potential buyer gets the SIM until they sign an NDA. And so that goes to a much smaller subset of potential buyers. The way we run a process is we'll send the sim out. Well, I'm sorry, we'll send the teaser out, the one-page summary to, depends on the type of deal. It might be 100 different buyers. It might be 1,000 different buyers based upon the type of deal that it is. Um, Once the teaser goes out, we'll get somewhere between 50 and 100 potential buyers that want to see the sim. And then we'll send the NDA and the SIM out to, 50, 75, 100 potential buyers. And then we'll have conversations with probably 30 to 50 of those. And then from the 30 to 50 that we'll have conversations with, we'll get preliminary offers from maybe 10 to 15. And this is where it gets interesting. So before we bring a deal to market, we've done evaluation and we've had conversations with the seller as to where we think valuations are going to come back within.
Mhm.
Now, when we get these 10 to 15 offers, and
Have you
if you've
also
done
asked them, or have you ever also made a guess on deal structures and percentages of that enterprise value, like where it's going to be allocated?
yeah, and we'll say, we think the value is going to be in the 10 to 12 million dollar range, and we think somewhere between 50 and 70% of it's going to be in cash, and 20% of it is going to be in rollover equity. I mean, in an earnout, and maybe 10% in rollover equity. And so we'll begin to frame what the structure is. And so when we get these offers in, probably 60% of the offers that we get fall within the targeted valuation range that if we did our job right,
Hmm. Hmm.
they fall within that range. And then there are going to be 20% that are above that range and 20% that are under that range. And so we'll take these 10 to 15 offers and we'll skinny the list down to maybe 5 to 10. And then the seller and these 5 to 10 buyers will have management calls, and they'll get a chance to get
Question
to
before
know.
you start. Have you validated where they're getting their capital, whether they have the
Yes.
money and can do the
Yeah,
deal?
yeah.
Because I think
And
that's
so
an
and
important to
so and
note for
so
you.
part,
Yeah.
yeah. And so when we skinny the list down from the 10 to 15 that we get offers from, and maybe more, to the 5 to 10, we have vetted these buyers to be sure that we have confidence that they've got the capital and they can close within a reasonable period of time. And so we've done our best to vet that list down. And so it's a qualified, vetted list at this point. And so we have the management calls. The seller and the buyer get a chance to talk to one another. The buyer gets to ask them questions. The seller gets to ask the buyer questions. Everybody gets to know one another. We'll do this with all of these 5 to 10. And so the seller gets a very good feel as to who's out there and who's interested in the business, what their background is, what their experience is, similar deals like this that they've done, uh, what their value system is, what their culture is, what their strategic plans with the business are. I mean, it's
That
everybody.
that right there. Let's touch on that for a second, because I think that this is so important, John. We're like, why I've why someone in your role is so freaking important, because by the time that they get to those five get-togethers, the meet and greets, like, let me see if I can regurgitate this correctly. There's an expectation set on valuation. You got the bell curve there. Expectation set on the deal structure. So it's been milestone one, milestone two. Then there's conversations that you've had. So when you skinny down that buyer list, it was, if the seller told you what their desires were for the legacy, the culture, their specific, I'm thinking about the person that you and I are talking to, like their specific intentions of how long they're willing to work and not work. And obviously the word it depends on the person that they meet, but there's like this whole like working strategy that has to be nested within the deal structure, nested within the valuation. So because I know how intuitive and emotionally intelligent you are, you've gone through those. And I just see so many people that don't do that. So like by the time those meetings happen, it's not like, oh, I love John and we're great. And then it's like, well, I'm planning on firing these people. They got the wrong deal structure. And so that's all that wasted time. So is that a
Yeah, no,
appropriate way of saying that?
yeah, and I mean, you've got to remember the group that's buying the business. They're buying the business's ability to continue to produce that cash flow
Mm-hmm.
profit, and their ability to grow that cash flow profit. And so, I mean, we come back and talk about owner dependency and the risk of owner dependency. I mean, one of the things that can harm a business from a valuation standpoint is if there's so much of the business that's dependent upon the owner. Then, I mean, think about it from the buyer's perspective. If the buyer is buying this business and the business is so dependent upon the owner, and the owner plans on walking away from the business 90 days after it closes, then how does the buyer have any confidence that
Right.
the revenue, the customers, the employees, anything's going to stick around? He doesn't. He doesn't.
Yep.
And so, I mean, if they're going to buy the business, they've got to manage their risk. Of course, they're going to beat you up from a multiple standpoint.
And the deal structure standpoint. And
The whole friggin' thing. The whole friggin' thing. Yeah, right.
and John,
Absolutely.
this is where like sometimes I feel like I'm bearer of bad news, and I don't know if you feel that way sometimes too. Where like there's no easy button, like what you just said. Because like if you think about back to the beginning part of the conversation, it was people are tired,
Yes.
the death spiral, so
Yes.
they want to hit this punch out number, but then like it's either going to be impacted on the enterprise value, or it's going to be impacted on the deal structure, or it's going to be impacted on their job. So like at every one of those gates, the realistic expectations are going to snap back into reality saying, John, there is no easy button, dude. Like, I don't know. There could be potentially,
Ryan,
but
have you ever run a marathon?
no, for
Yeah.
so many reasons.
Yeah. So
I run
I
four
ran,
miles and then I stop and then I'm done.
I ran one. I ran
I
one,
ran one.
and yeah, and I swore I'd never do it again. But the thing that I remember, and there are a lot of things I remember about that marathon, but there were hydration when you're running a marathon is like so important. And the guy that I was training with, he had run a bunch of them. He said, John, you got to keep drinking water even when you're not thirsty. You got to keep drinking water even when you're not thirsty, because if you wait until you're thirsty, it's too late at that point, right?
I like that a lot. I
Okay,
like that a
okay.
lot.
Well, you know, when so many owners of businesses come to us, it's almost like it's a ball game, and it's in the eighth inning,
Mm-hmm.
and they're the game's about to be over, and they start coming to us wanting to talk about the business. And like, I mean, from a valuation standpoint, from a deal structure standpoint, whatever, we we can help them, but there's not enough time, and they don't have enough
The gas in the
energy.
tank, like you said. And it's probably all three of those buckets too. It could be the 35-year-old and the
100%.
7-year-old.
Yeah, yeah, yeah. And
Yeah.
so what they really should do is they should come see us 10 years before they're even ready to sell, so that we've got time to work with them, where they've got energy to do the right stuff so that they can have the right outcome. You know what I'm
Mm-hmm.
saying?
Yeah, I do. Yeah. So it's because like, and then we can go back to the continuing your process. But like, I think of like, it's, they're coming to you at the eighth inning, but they don't know what sport they're playing
Right,
because they're not following the valuation, the cash flow
right,
paradigm shift of what we were
right,
talking about, which is shareholder
right,
value. So it's like
right,
they come to you and say, hey, John, I kind of want to be done with
right,
this sport. And it's
right,
like, hey, dude,
right,
it's at the second inning. You
right,
actually have 8 innings and you
right.
thought you were done after two.
Right. Okay, so let's go back to the
You got the
process.
five
So
meetings.
yeah. So we've got the 5 to 10. We get final offers. We play these offers off against one another, and then we sit down with the seller, and we lay all the offers on the table. So you've got these six final offers. Here's option A. This is what they're willing to pay for it. This is what the deal structure is. You remember talking to these guys? Yes, I remember talking to these guys. This is option B. This is what they're willing to pay for the business. This is the deal structure. Do you remember talking to these guys? Yes, I remember. I remember talking to these guys, and then go through the list. And so, at this point, we're probably 3 to 4 months into the process. We've run a market clearing process. We've sent the teaser out to over several hundred people. We've sent the sim out to 50 to 100. We've had conversations with 35 to 50. We've gotten IOIs from 10 to 15. We've had management calls with 5 to 10. And now we've got final offers from these six, and the seller has to select the offer that they want to go with. And it's going to be price, it's going to be deal structure, it's going to be culture, value system, vision,
Operator role and
operator
culture.
role. It's going to be a bunch of things. Going to be a bunch of things. And so at that point, you're 4 months in, you're 3 months in, select the offer. Now we've got to get through quality of earnings. We got to get through the rest of due diligence, and we got to get through all the legal review. And that process is a hard 90-day period to get through. There's a lot involved. Quality of earnings, all the financial information that the buyer has seen has been information that we the seller have supplied to them. And so they've got to hire a forensic accounting team that's called a quality of earnings team that they've got to go through and they've got to do an audit to verify that all the numbers that they've seen from us are verifiable numbers that they can support. And that's a very laborious process.
It's a cavity search.
It is, and it can take 30 to 45 days to get through that process, and it's tough because they're going to go back 3 years. They're going to drill through all the P&Ls. They're going to drill through all the cash flow statements, the balance sheets. They're going to look at credit card statements. They're going to look at bank statements. They're going to look at receipts. They're going to verify.
They even went through, like, we had 3,000 contracts. So they went through contract audits. I mean, it was everything.
It's a bitch, dude. It's a bitch.
That's exactly right.
And you gotta get through that, and then you got to get through the rest of the diligence, and then you've got purchase agreements, and you've got consulting agreements, and you've got employment agreements, and you got to get through all the legal stuff. And so getting through all the quality of earnings, the diligence, the legal stuff, I mean, that can take another 90 days. And so from when we take an engagement on till when the deal actually closes and money gets wired can take 6 to 9 months. Now, you
The 20% more than that, 20% less than that, kind of thing.
Yeah. Now, we're very picky on the deals that we take, and you hear all these crazy numbers about 80% of the deals that go to market never get sold, and I would say that's true, and they don't get sold because they probably shouldn't have been brought to market.
Is it mainly, do you think, if you were to actually double click on that, do you think it's mainly brokers because they just list the thing on the website? Because if it's an investment banker like you or any of the, like, Prairie Capital or any of these people that I know that are on the low or larger end of the market, you're not going to waste your time with something you can't sell.
No. So we don't charge a retainer. We don't charge any money up front. We only get paid if a deal gets done. And I would say 80 to 85% of the deals we bring to market get closed within that 6 to 9 month period of time. And so, and part of that is we're so damn picky on the deals that we take on. We don't want to
It's valuation, expectations, all that stuff.
It's just not worth it. It's not worth it.
Yeah.
I mean, we've got to be crystal clear that the seller's expectation is reasonable. There's going to be good demand for the deal in the market. We understand exactly what structure that they're willing to do. We understand exactly what their transition timeline on.
Is there industries that you gravitate towards?
We do a lot of blue collar trade work. HVAC, plumbing, electrical, roofing, garage door, blah, blah, blah. We do a lot of manufacturing stuff. We do a lot of industrial stuff. We do a lot of logistics, distribution stuff. I would say the stuff that we don't do technology stuff. We don't do healthcare stuff. I mean, some of the,
It's like, really, I call it real things for real people in the real economy, right?
No, I mean, what's the guy's name? Mike, who's the
Mike
blue
Rowe?
collar? Yeah. I mean, think of those businesses. That's us. Yeah.
I love it.
Yeah. It's just, it's America. I mean, that's what we do.
Because, like, what happens is it's the cash flowing companies that, like, are doing real things for real people in the real economy. Because, like, when I think about all of the distractions that I've seen, John, over the last 7 years, is like, we still have copiers and we fixed them. Like, it was real shit. And I got, basic stuff. And like, the Amazon FBA companies, and then the SaaS, and you got all this stuff where, like, the money and the cheap money chased all this stuff, and all the valuation expectations were so distorted that I think everything's kind of going back into the normal stuff. But
Let me finish the journey because there are a couple of last pieces here. And so the deal gets closed, and if there is an earnout component there, meaning if the business hits certain financial thresholds over the next year or two, a piece of the sale proceeds will come in the form of bonuses that are paid as those earnouts are achieved. If those earnouts are there, then the seller's going to want to stick around long enough to be sure that the business hits those operating thresholds, to be sure that those earnout
Do you think an
bonuses.
earnout is it simple enough to just say an earnout is a bonus?
Yeah,
Because
yeah,
like a rolled equity is your equity tied in with the
correct,
future holding company. A
correct,
seller's note is a guaranteed note contract for deed with a
correct,
promissory note. But
correct.
an earnout is, hey, I
It's a
wanted
performance bonus. It's a
right, I
performance
wanted
bonus.
to pay you 5x, but I'm paying you 3x, and
Yeah.
like we're not doing rolled equity, not doing the seller's note. It's going to be we can pay you that if the company does all these things.
Yeah, yeah. I'm going to pay you 10 million for the business. I'm going to give you six in cash, and I'm going to give you 2 million in an earnout. And if the business hits a certain revenue target next year, I'll give you a bonus of 1 million. If it hits another revenue target in the second year, I'll give you another bonus of 1 million. And so they're structuring a piece of the payout predicated on the business hitting certain financial thresholds. It's just a bonus. It's just a bonus. The final piece is, even if you're getting all cash for the business, and even if there's a good management team in place, the buyer is probably going to want the seller to stick around for a period of time to help with the transition. It might be a 3 month transition. It might be a 6 month transition. It might be a 12-month transition. And they're going to pay you for that, but they just want to be sure that you're around to ensure that everything gets transitioned over properly. I remember in the conversation that we had with your client several months ago, they were very specific in terms of she wanted the business sold within a certain period of time, and she was willing to stick around for a transition within another period of
Like
time.
another year. Yeah. So it ended
But
up being
yeah,
two years.
but when you add all those up together, she was very specific. On January 31st of this date, she wants out of here.
Mm-hmm.
And so you've got to be sure, as you're thinking through the timelines, that you're backing that entire calendar all the way back up.
I know, which ends up being 2 to 3 years.
I know it
I
does. It
I
does.
know, and God forbid. I mean, like I got a client that called me this year. He sold his company for 50 million bucks to a PE firm 4 years ago.
Mhm.
He finally quit. He's like, I was chief of staff of nothingness for 300
Yeah.
grand for three
Yeah.
years, and that we couldn't get anything done. He's still got millions of dollars of rolled equity, and it's stuck there.
He's
He
just
made it,
hoping
but
it's going to pay off one day.
well, and like the thing is, but he did. I mean, I worked with him 6 years ago. He got all of his needs met
Yeah.
at
Yeah.
closing. And he just is like, this is just annoying. I have to talk to you guys. But like, I think to your point, it's just like there's a lingering effect that, like, John, what I want for people, and you do such a good job at explaining this process to people that, I think about the 500 podcast interviews that I've done about all this stuff is I want people to be able to go through every one of these milestones with eyes wide open, where they are intentionally choosing what they're going to do next instead of being pushed there. Like, again, going back to the healthcare system. I mean, my dad was getting surgeries that he never needed because even the Mayo Clinic was just piling on insurance codes. And like, you're a good person. And like, I like what I have, what kind of the thing that the mission that or the belief that I've had is education can hopefully level set this. And I think about Andrew Huberman. It's like, yeah, he talks about really complicated health stuff. And the way I think about it is like what I'm trying to do, and I think you're doing the same thing, is here's how it all works. So that way you can see like, hey, it sucks to elevate your level of education when you were a plumber and you're like talking about this shit and you don't want to. But it's like, if it's $15 million in your livelihood, it might be worth learning about some of this stuff. But then when I think about like what gave me joy is like when I hand off the baton of my client to you, it's like I watched them go, okay, I went through all my goal setting. I did all the hard work. I kind of looked, they had that visibility of the is it worth it conversation to look at the next 5 years. And they go, but now they can just like sit back in the passenger seat to say, okay, John, guide me. Instead of having to be like me, I get so crabby, John, when I
I hear
watch
you, man. No,
people get
and
screwed over. It just,
the analogy that I use is going back to a football analogy, sort of being the M&A advisor. I'm the guy that picks the ball up at the 20-yard line or the 15-yard line after they've worked with guys like you for years and years and years. And I'm the guy that's got to punch it over the goal line and score the touchdown. And so I'm taking all the work that the owner has done for all of these years and all the work that you have done with the owner for all of these years. And then we're the ones that are turning all that work into reality, which is this transaction that everyone's been talking about for years and years and years, making that transaction real. And so I've got to carry that ball over the goal line and manage everyone's expectation all the way to the end.
yeah. And it's so fun to hear what you're doing. I appreciate it so much. And um, I'm trying to think if there's anything else that we haven't covered. I mean, you did a great job, man.
The last thing,
Yeah,
uh, gross sale proceeds and after tax
yeah. I want you
sale proceeds. It ain't the same number, dude.
I'm
It
aware.
ain't the same number.
I was,
remember,
yeah,
remember, Uncle's there, and Uncle wants his.
yeah. And it's about backing. I think what's working so well is as I watch some of my clients go and say, okay, I do want to sell to a third party right now. What gets me comfortable about the handing them off to you is you're protecting them and guiding them, managing the expectations of the legal team, the tax team. So that way, and I'm trying to say this without being too rude. It's like, you don't need opinions from the CPA or the attorney necessarily. And that's kind of where it's like, we don't need any more cooks in the kitchen here. It's like, there's very specific, like the ideas have all been set. And we're always like, in here, we just need things to be collaborative, discussed, architected in the way that we're trying to drive it forward. And too many people want to be the king of the ideas to provide their value and their fee. And as they go down that route to say, okay, like here, I just feel like they're going to be taken care of. And so they're thinking about all this stuff. And I think it's just interesting, John, because like I am spending a lot of time with, when I think about my clients, it's probably now like 60 to 75%. They don't want to sell the business to a third party. And I have engineered a couple recent of like internal buyouts where it's like this multi-stage internal buyout. They sit in the boardroom and then there's either a target ESOP or a full buyout. And it's just interesting because I think we all did a lot of work to say like, are you sure this is the right approach? But it's so different how different approaches those are. And like, that's why I want to figure out how to collaborate with you more, because like, as people raise their hand, like with this one client of mine, it's like the game, because over the next 12-month game becomes wildly different if you're planning on going to market to a third party than if you're going to keep it. And that's where I literally like, and I want to hear your reactions on this. I think that when you run a business, 90% of it is the same game of just creating shareholder value and cash flow until you see a line of sight of there will be a transaction in 12 months. And then things start becoming different. Like I have examples of like whether you should or shouldn't do a whole new ERP implementation or buy a company or do a big leadership management change. Any comments of like once that line of sight becomes visible, like how to start thinking about this?
I think within 12 months, you don't need to do anything significant. You need to lock the business down. I agree with you.
Yeah, that becomes because all of a sudden, like I had a
There's too
client
many
that,
moving pieces and it creates uncertainty in the buyer's
yeah,
mind.
yep, yep,
Yeah,
yep,
but remember, buyers are buying businesses' ability to produce cash flow, and they measure their risk by the multiple that they're willing to pay. If you're doing anything that's putting additional stress or risk within the business, a buyer's going to pick up on that, and he's going to beat you up in the multiple that they're willing to pay for it.
and the deal structure.
And the deal structure. And the deal
Yep,
structure.
yep, yep.
Yeah.
This is so fun, man.
Let's do
Thank
it
you for
again.
coming on.
Thank you, brother.
This is so fun. They can reach you at what you
Just
want to.
yeah, they go to brentwoodgrowth.com. They can hit me up on LinkedIn, John Bartlett. They can call me 908-377-7807 or email me jbartlett, Bartlett, at brentwoodgrowth.com. And as I hope you can tell, I love talking about this stuff, and I love talking to business owners and just helping them explore options.
Thanks, John.
Okay, brother. It's good to talk to you. Later, man.